Hi, I'm Professor Bei Dong from USF School of Accountancy. Today, we're going to cover some topics related with depreciation, impairments, and depletion. In this video, we're going to talk about the depreciation of property, plants, and equipment. Talking about depreciation, it is a method of cost allocation. First of all, it is our accounting way to allocate the capitalized cost of property, plant, equipment over the years it is benefited. The reason why we recognize depreciation expense is because there's a devaluation of those property, plant, equipment because of the usage. To be consistent with our matching principle, we need to recognize those depreciation expenses with the revenue in the same period that is generated by the asset usage. And secondly, depreciation will decrease the carrying value of the asset, but it is not a valuation technique. The carrying value here means the book value of this asset. Book value and market values, they are different. Theoretically speaking, market value of any asset is determined by the market demand and market supply of that asset. Thirdly, all the depreciation method will result in the same total expense over the life of this asset, regardless of the depreciation method you're using. Okay, the total amount we're going to depreciate is the historical cost or acquisition cost of this asset minus the salvage value. That is the total depreciable cost. Then different method will actually generate different patterns of the depreciation expense during the life, but the total amount of the depreciation expense over the life of this asset will be exactly the same. In terms of calculation of the depreciation expense, we need to consider the following factors. First of all, acquisition cost, or you can call it historical cost. So this is the money you actually pay when you get that asset. Secondly, useful life. This is the period of time over which the asset is expected to generate cash inflows. So this is a variable that needs to be estimated by managers or accountants. Thirdly, salvage value. This is the expected disposal amount for the asset at the end of its useful life. Again, this one needs to be estimated also. Fourthly, you need to pick depreciation method. You can pick activity method, you can pick straight line method, you can pick sum of the years digit method, or declining balance method. So in the next couple of slides, we're going to talk about those depreciation method one by one. For those factors we just covered, any company can depreciate their different assets using different depreciation method. They can change the depreciation method. They can change estimate of useful life, change estimate of salvage value during the life of an asset. Now, I'm going to use this common example to demonstrate differences among those 4 different depreciation methods on the depreciation expenses in different years. Okay, so we have a company purchased a car on January 2nd, 2007. The historical cost to acquire this car is $10,000. Estimated life 4 years. Estimated miles 100,000 miles during the whole life of this car, which means that they expect this car could be driven by 100,000 miles totally. Salvage value $2,000 after the 4th year. And we're going to calculate depreciation expense for the first 2 years under those 4 different depreciation methods. Now, let's first see activity method, or you can call it units of production method. This method particularly says that the more you use a particular asset, the higher the depreciation expense. Assume that for this car was driven 20,000 miles in the year 2007 and 30,000 miles in 2008. So we're expecting to see, in 2008, depreciation expense will be higher under this activity method. Using this method, the annual depreciation equals cost minus salvage value. This part is what we call total depreciable cost, divided by total expected activity. So this one gives us the unit depreciation expense. And then we times the current activity of this year. So for example, in this case, in 2007, the total depreciable cost for this car is $10,000 minus $2,000. Okay, that's $8,000. And then divided by total expected activity for this particular case is 100,000 miles. So this part is the depreciation expense per mile. Okay, and then in 2007, this car was driven 20,000 miles times 20,000 miles, okay, which equals $1,600. 2008, similarly, we get this, depreciation expense per mile that is exactly the same across different years. But in 2008, this car was driven by 30,000 miles, so you times 30,000 miles, and that equals $2,400 in this year of this depreciation expense. The second method we're going to demonstrate is straight line method. Straight line method is the most popular method, okay, and it is very easy to calculate. Every period depreciation equals the cost minus salvage value, which is the total depreciable cost, divided by the estimated life. For this particular case, the historical cost is $10,000, salvage value is $2,000. Okay, estimated life is 4 years. So every year we're going to depreciate exactly the same thing, $2,000. The third method we're going to demonstrate is called the sum of the years digit method. For this method, every period, the depreciation expense equals the number of the years remaining at the beginning of the year divided by the sum of the years as the denominator, then times our total depreciable cost, which equal historical cost minus salvage value. For example, for this case, in 2007, at the beginning of the 2007, since this is the first year, okay, there's still 4 years remaining, divided by the sum of the years, which equal 4 plus 3 plus 2 plus 1, which is equal to 10, okay, then times our total depreciable cost, $10,000 historical cost minus salvage value $2,000. So in 2007, we're going to depreciate $3,200. In 2008, follow the same formula. At the beginning of 2008, there's still 3 years remaining, divided by sum of the years, which is still 10 years, okay? Then times our total depreciable cost, which is $8,000, gives us $2,400. So we can see that using this method, our annual depreciation expenses actually will decrease across years. The last method we're going to demonstrate is called declining balance method. Here, I'm going to use double declining balance method as an example to demonstrate this accelerated depreciation technique. Using this technique, it will help us to generate more expense in the early years and less in the later years. So in the first year, we always have the highest depreciation expense. So if you're using double declining method, the depreciation rate of every year is 2 over n. For this particular case, since the estimated useful life is 4 years for this car, so if you're using the straight line method, every year we're going to depreciate a quarter of that value, which is 25%. If you're using double declining method, we double that 2 times 25%. So every year we're going to depreciate 50%. So in 2007 for this car, we're going to depreciate 50% of the carrying value of $10,000. That is $5,000. In 2008, we're going to depreciate 50% of the carrying value at the beginning of the 2008. The carrying value at the beginning of the 2008 equals the historical cost of $10,000 minus the $5,000 of last year's depreciation expense, which equals $5,000. So 50% of $5,000, that's $2,500. So we can see that in the first year, we depreciate 50% of the whole carrying value. And in the second year, we depreciate $2,500. So we can see that the balance of this car actually is decreasing over years. And this one we demonstrate is called double declining. You can easily replace this double, this 2, with any of the ratio you want. Could be 40%, could be 60%. Okay, so it is a general way to demonstrate this declining balance method.